Good day, everybody. My name is Ted Gardner. I'm one of the portfolio managers on Westwood Salient's energy infrastructure team. Today, I'm just going to hit some of the February highlights and then move on to some of the geopolitical issues that have arisen in the Middle East. We had a great January to start the year, followed by an even better February for the AMNA and AMEI, which were up 9.5% and 9.6% respectively during the month. The AMZ, which is the MLP only benchmark, was a bit behind for February, but still up a very respectable 7.1%. Year to date, the AMNA leads at an 18.3% gain, with AMEI just behind at 18.1% and the AMZ up 15.7%. As you might expect, the broader energy equities have outperformed with the commodity moves we've seen thus far this year. The XLE is up 25.1%. The producers, which is the XOP ETF, is up 21.8%. And then oil services have actually led the group, up 32.7%. On the commodity side, oil is obviously the big story with what's occurring in the Middle East right now. It had a big move in January to start the year, but a much more muted move in February. However, since the bombing of Iran began on January 28th, as of this recording, oil is up about 20% since the end of the month. Looking briefly at the top and bottom performers, WaterBridge was the top performer for the month, up 20.6%. We believe that is due to some expectations that perhaps volumes may not be as bad as feared in the Permian Basin following the move that we've seen in oil prices. On the downside, New Fortress was the worst performer, down 18%, and they are in the midst of trying to restructure some of their debt. Year to date, Venture Global, which was actually the worst performer in 2025, is up the most so far year to date, up 42.1%, while New Fortress is once again the bottom performer, down 4.4% for the year. So now let's talk about what's going on in the Middle East. Again, the U.S. and Israel began bombing Iran on February 28th. And we've shown this slide a bit in the past during previous Iran flare-ups. And it shows the geography of the area and really how narrow the Strait of Hormuz is and just how vital that is to global energy supply. And as I'm sure you've seen in the headlines recently, we have about 20% of global oil supply flowing through that strait daily, as does about 20% of global LNG supply, which originates from the country of Qatar. In the most recent version of the slide that we used last summer, we had a bullet that said we view the closing of the Strait of Hormuz as a low probability, enormous impact event. And the fact is that despite the low probability, it has happened, and the Strait of Hormuz is effectively closed, at least as of the time of this recording. First of all, we had insurers like Lloyd's of London pull their war risk coverage on the cargoes in the area. Then we had Iran say that they would destroy anything that tries to move through the strait. We did a couple of days ago have President Trump say that the U.S. would insure those cargoes, but we haven't really seen any meaningful movement since then, and oil has continued to move higher. So it's a very fluid situation, obviously, and any stats that I were to quote today may very well be obsolete before this video hits your inbox. But I did want to highlight some of the big picture items that we are keeping track of. First of all, to state the obvious, the longer the strait is closed, the greater the impact will be on energy markets. Coming into the year, the oil market was roughly 2 million barrels per day oversupplied. With the closure of the strait, that would turn into about an 18 million barrel per day undersupply, but countries like Saudi Arabia and Iraq do have the ability to divert some of their volumes to the west. So we believe that's somewhere between 5 to 7 million barrels, but you still end up with a 10 to 12 million barrel a day undersupply situation at the moment. And at that rate, it really doesn't take very long to erase all of the inventory builds that occurred during 2025. So we've already seen Iraq shut in about 1.5 million barrels per day of production because they've run out of storage, and others we believe will follow in short order. So even if the conflict ends tomorrow, we don't see oil moving back to its lows that it was at before all the geopolitical events began in the foreseeable future. The LNG market is also in a bit of disarray. Everyone was pointing to a global oversupply situation starting to take shape later this year. But the Ras Laffan facility in Qatar has come offline, and it is the largest facility in the world at 77 million tons per annum, and that's on a 500 million tons per annum global market. And restarting that facility is a process. It's not just a simple flick of the switch. So once they do decide that the danger is past and that they're willing to bring production back online, it could very well take a month or more for that to restart. So with that one facility being offline, in our opinion, that takes the oversupply situation off the table near term and potentially even over the longer term. So to reiterate, the longer the conflict lasts, the greater the impact will be. If it drags on, we could very well see oil prices move to levels that would be needed to create demand destruction, which in our view would be well north of $100 a barrel. But if it ends tomorrow, we could see prices come down fairly quickly. But we do believe that there would be a risk premium that stays in place, and we would have to bring the Middle East production back online that went offline. We'd have to rebuild some inventories. So we would view the prices to be unlikely to drop below $60. So the information flow, as you can imagine, is fast and furious right now, but we will be sure to pass on any information to you that we believe is vital. Thanks for joining us today. We hope you found it helpful. Please reach out to your Westwood representative with any questions.